Hi, welcome to today's Carrier Update. My name's Dean Croke, Chief Insight Officer at FreightWaves. Today we want to talk a little bit about the Pacific Northwest and some of the freight market imbalances we typically see. In particular, we're going to talk about the state of Washington, which is a #1 producer of things like apples, pears, onions, raspberries, potatoes. It's also the largest producer of apples in the country. It produces something like 125 million boxes per year. That translates into about 2.5 million tonnes. About 30% of that goes for export to about 60 different countries. And of the 70% of the annual harvest that's left, most of that goes by road. And when we break it down into truckload shipments, it's something like about 200 loads a day gets shipped out of the Pacific Northwest across the entire country. On the chart behind us, you can see to the right the Pacific Northwest, which are the dark blue areas up here. You can see the markets of Spokane, Washington State, Portland, and then right in the top left corner you can see the market of Seattle, which is white. And what we're looking at here is the refrigerated tender outbound reject index, which tells you about capacity and spot price movement in that particular market. The darker the blue, the higher the tender rejection rate for refrigerated trucks, which means that spot prices are generally going to go up and capacity is tightening, which is consistent with the increase in produce out of that particular market this year. So there's already a lot of tightness in that market. There's a lot of carriers who want to run into the Pacific Northwest. But the message today is that if you're a motor carrier in the Seattle market, which is a strong backhaul market, then it'd be a good time to run a couple of hours Deadhead over to the Spokane market or even the Twin Falls or Pendleton markets, especially around the Yakima Valley. So in the Spokane market, if we have a look at our next chart here, you can see that tender volumes have increased about 47% in the last 4 weeks. The tender rejections have actually averaged about around the 30% mark over the course of the year, which is telling you that carriers are rejecting about a third of all the loads that are sent out of the market. Right now, today, tender rejections are up here at the 23.38% mark. So volumes are increasing. Just in the last week, volumes have increased about 45%. So what you can see is that as volumes are increasing towards the weekend, the blue line here is the volume, and over here on the green line, that's the refrigerated tender reject index. You can see it's increasing. But on the orange line, which is the Seattle market, you can see that Seattle refrigerated tender rejections are going down, which tells you in the Seattle market capacity is loosening and there's downward pressure on spot rates. So if you're a carrier today in the Seattle market and you're looking for loads on the weekend to get your drivers out of the Pacific Northwest with some weekend miles, then you'd want to run the 200 miles or the 2 hours deadheading into that specific market. 2 hours will get you to the east side of the Washington state where there's a lot of apples. A little bit further out in the sort of 100 to 200 mile deadhead range, you'll start to get into the markets where there's more apple production and things like hops, etc. So that's the message today, the carrier update. If you're in the Pacific Northwest on Friday and you're looking for some weekend miles for your drivers, there is plenty of freight, especially out in the Spokane and Twin Falls area, particularly in the Yakima Valley, right in the middle of Washington.
Improve your fleet's efficiency with at&t Fleet Complete, a 4G solution for tracking vehicles and simplifying ELD compliance. at&t Fleet Complete, delivering fleet solutions for every business.
Welcome to Futures Friday, right here from Freight Alley. Talking to Kyle Lintner from K-Ratio. K-Ratio is a commodity trading advisor that is based in Chicago and focused specifically on the freight futures market. Here at FreightWaves, we've been working with K-Ratio to build information to help empower companies to understand how to trade. Right here, Kyle, tell us a little bit about your background and how you got into specifically freight futures.
Right, so I've been involved in futures for more than 20 years now. I've been trading my own account for 16 plus years. I'm a member of the Chicago Board of Trade since 2006. So futures is all I know. But I've had a lifelong friend who was in logistics, and oddly enough, he left Transparency 18 when you announced this new exchange and this new idea for freight futures. He called me up, said, could you take a look at the parent company risk, which was a Chicago-based 3PL. In the process of figuring out how things would work, kind of came to the discovery that futures was a little different than freight, and ideas and concepts weren't getting through as easily as I liked. So the idea was that this would be something needed in the industry. So we formed K-Ratio to bring some of that knowledge outside our four walls obviously to monetize it, but the educational learning curve can be steep. So anything we can do to lessen that load and make things easier from a conceptual standpoint on how to take the risk inside of your business portfolio and place it into the market is kind of where we come in.
So explain what a CTA is. I mean, it's a term that isn't well known in the freight industry,
right,
but it's important in the commodities and futures industry. A little bit about what a CTA is.
Sure. So it stands for Commodity Trading Advisor. And what that means is we're just licensed and regulated, approved to provide risk management services, advice, execution for accounts specific to futures trading. So primarily what we do is service people with an end use for the underlying. In this case, it's shippers, carriers, and 3PLs.
So when a firm decides they want to either hedge or potentially speculate on the futures market, but they don't have the internal expertise, but they want to participate.
Right.
They don't internally have the resources. Would they come to you?
That's where we come in. So they probably have a very good idea of what they have from a risk standpoint. They know their lanes if they're a shipper, they know their shipments. If they're the carrier, they know where they operate. If the 3PL, they know both sides because they're interested in the margin between. But they don't know how to translate that into the market. Futures trading is something that only professionals should get into. So if you can understand what you have, but you don't know how to place it into the market, that's kind of where we come in. It's just a conduit between you and the marketplace.
So really provide education. You're talking to 3PLs, you're talking to shippers and carriers as well right now.
Right. All participants. Equal risk amongst all three, I'd say. Obviously right now it's probably more advantageous for the shipper due to where we are in the rate cycle, but there's something for everyone.
And why do you say it's more advantageous for the shipper right now?
Low rate environment. From 2019, last year we had all-time high in rates. Quickly we've turned around. In my short time in freight, I've noticed that it's kind of everybody over to one side of the boat. And that's that fragmentation that we're all trying to eliminate. Right now with this marketplace, we have complete price transparency for all. And for everybody to see that, we can make better decisions from a business standpoint. So we get less of that too much capacity, too little capacity not in the right places mentality.
So if shippers are anticipating rates going up and concerned about how do they manage the cost in freight in the physical market if costs go up, this gives them a chance to lock that in.
100%. That's the name of the game. So a shipper would initiate something like long coverage. For us, we can go up to 16 months out. And that's the way to insulate you from any sort of increase in rates, because if rates were to move higher, obviously you're still paying that real world. But the offset from the gain in your futures account makes it a moot point.
Now what happens when the truck doesn't show up?
Well, there's no trucks. There are no trucks.
Explain that for me.
This is a financially settled contract. So what that means is that instead of any sort of functionality or facility for physical delivery, this is going to be cash settled. There will be no truck ever involved. So from a practical standpoint, your providers will always stay the same. Whoever you're using to move your freight doesn't change. We've just removed the financial component of that, placed that into the market. So now we can de-risk your spend. If you're a carrier, we can take it from a revenue standpoint. But whatever you're doing in the real world with the trucks or the loads, keep doing it. We can now just take what you're going to pay or receive for that and put that into the marketplace so we have zero risk involved with it.
So shippers, traffic managers that are routing freight and have specific service providers they like doing business with, they'll continue to do business with those providers. Doesn't change anything about how they're managing their book.
No.
But what it does is gives them the ability to offset the potential of prices and rates going up.
Right. If we think about it from a shipper's perspective, even if you want to stay in that thought of contract rates, which we know aren't very well contract, they're paper rates. If you have spot business that's coming up, you don't know what you're going to pay for it in the future, but this is a tool to provide you not just the price for it, but then lock it in.
So if shippers are concerned about prices going up and rates going up, then this gives them the opportunity to hedge it. What about carriers? I mean, the interesting thing is you said all parties get on either side of the boat based on where the market's at.
Right.
But you have to have two sides. So how do you encourage folks that would be, that are naturally long in the physical market to actually short their positions?
Right. So with every futures contract, there is a buyer for every seller. And if you're a carrier right now, you can look at something outside in the market and say, is that a price that I want to run my trucks for? If we think just a month or two back for the June national average, right? We started June 1st at $1.66 on the futures. The underlying was around $1.50. So that's a situation where we get into June, obvious seasonality, we get our typical bump in loads and price makes sense. We didn't get the bump that we all thought we were going to see. So what happened was the futures market came down. So that seasonality is always going to be baked into the forward curve. But if that seasonality doesn't materialize, rates are going to come down. So now we have situations where as a carrier, especially now given where we are at in 2019, you might be having a difficult year. You can look further out 3, 4, 5 months and say, that's a price that not only I want, but I need. And if that price doesn't happen, things could get bad. So it's a way to maintain a certain amount of revenue for the company, fix it and lock it in.
You know, it's interesting. If you look back at carriers in 18,
Yeah.
I bet a lot of those trucking companies looking back and where we're at in 19 would have loved to have hedged.
Right.
In fact, if you looked at where the market launched and where it has traded, if they had actually locked in, they would have been better off.
If you started on March 29 when this opened, things would be different. And you know, that's one of the ancillary benefits that's often overlooked is from a budgeting and accounting perspective, if you can properly account for what you're looking to do. If we go back to 2018 and everybody ordered new trucks, right? So if you can plan out for 16 months and know what your cash flow is going to look like, it changes the game as far as how you want to grow your business. And then when you have the ability to lock it in, it's kind of a no-brainer.
Got it. And so we're seeing some activity now. One of the things about futures markets, it's not like launching a piece of software. It takes a while to build. And one of the things I've been very cautious, even from the start, is making it clear that this is a long-term, years battle of building liquidity. But we are seeing some companies jump in the market. We are seeing some activity and some trading, some big block trades. Talk a little bit about what types of trades you're seeing and what you anticipate over the next couple of months.
Sure. There has been a lot of activity lately. It's been increasing steadily, but it seems like now we've kind of reached a tipping point from a bids and offers standpoint. Specifically, we did see the big trade go through this past week.
It was a big block trade.
It was.
How many miles?
50,000 miles. So for October and November, we saw the LA to Dallas lane pick up 25,000 each month. But if we remember back to this being a futures contract, you know, there is a buyer for every seller. So the other side of it hedged as well. Theoretically, it was 100,000 miles that exchanged from a risk standpoint. I don't think it was a coincidence. The same morning of the trade, we saw that really strong retail sales print. So now we can start to put some of these pieces together and think about the reasons why. We're talking about upcoming holiday season. So LA to Dallas is probably the most important lane for that as far as getting the goods out for Christmas. So whatever the reasons may be, if it were a shipper or a 3PL, they're concerned with the potential for the price on that lane to move higher. And then for some of the reasons that we talked about earlier, if you're the carrier, $1.90, $2.10, those are prices you need for your truck. This is a way to lock that in. Or it could have been a 3PL that just liked it from a revenue standpoint. I'll take that dollar amount. I need to keep that money coming in. If it doesn't happen from a rate standpoint, things look a lot different.
Yeah, especially with trade and trade-in fluctuations. I mean, the thing that's happening right now is, you know, we just don't know what's going to happen. And I think the uncertainty, you know, if you go back and look, so Union Pacific CEO actually commented this is, in 40 years of his experience, he's never seen a market like this. And it strikes me as that's when you want to be hedging. When you know something and you're absolutely sure something's going to go up, you're absolutely sure something's going to go down, hedging is less interesting. But in a market where there's no visibility, and there's a lot of differing views on whether there's going to be a strong fourth quarter or a soft fourth quarter, it actually makes sense to hedge. And then looking into 2020, I can't imagine why anybody would think they have an accurate forecast of where that's going to be.
Nobody knows where the market's ever going to go, right? But you don't need to. You just need to know if it's a price you can run your business at and that you're comfortable with. And that's the tool that it provides. We're just trying to take the risk on your books and to put it into the marketplace for someone else to deal with so you don't have to. Let's just think back in this last quarter alone, how many truckload carriers came out or even 3PLs and didn't meet earnings?
I know it all too well, particularly some of the larger enterprise carriers that had high exposure to spot rates. You can see you can actually see it in the financials. You can almost look at the numbers and say these carriers had a lot of exposure to spot rates. Had they had hedged,
different story.
They would have had a much better outcome in the quarter.
Or even some of these 3PLs talking about their margins being compressed on specific areas. Same thing goes there. If you're a large 3PL, even if you're a small 3PL, you know, to secure your capacity expense, it changes everything. If we can maintain a certain amount of top line revenue and we can limit the amount we spend on the transportation, well, now you can preserve that level of margin. So from the 3PL or the carrier standpoint, especially the ones like we're saying that just came out with decreased Met earnings, why not hedge? Get rid of the risk.
So Kyle, if folks they're intimidated by the idea of futures, and I having been in it for a couple of years, I can understand it's not an obvious.
Right.
It's not as easy as a piece of software or product. But if somebody wants to understand more or potentially learn about trading, how do they get in touch with you guys, and what role will you play in helping them understand it?
Sure. So the easiest way to contact us, I'd say, would be the website. It's k-ratio.com. And what we can offer is full management of the account. We can offer execution for trades, as well as data analysis for how to take your book of business and apply it to the tradable lanes from a concept and strategy standpoint, so that it's an easier, smoother transition for you. Because like what you're saying, somebody's probably great at moving the loads or moving the trucks, but futures trading isn't their day-to-day business.
And how do you guys get paid when they do these transactions?
We have several different types of compensation structures, but it can either be a fee-based or a commission-based on trading activity, or we are open to open consulting projects.
So if a company has a large book, they can consult with you on a fixed rate, or if they want to be more transactional and get comfortable and familiar with it,
right,
they can pay you guys a small commission.
Right. This is an infancy stage for a new market, so we're open to all types of arrangements, and our idea is to grow with this and evolve with this.
But more importantly, at this stage, it's not so much about short-term income. You're interested in building the liquidity of the market.
Right, right. That's the number one goal for this market, and any market that starts out right. We have to not only increase the knowledge of the base of people using it, but we need to all get comfortable and figure out how it fits and works. Got it.
Well, thank you so much for coming in here today, here in Chattanooga, here in Freight Alley. We'll talk again next week about what's happening in the market. Hopefully there'll be some trades over the next couple of days that can help companies mitigate their risk or potentially speculate on where the market's headed.